Hello and welcome to the Joe DeLisi Financial Advisor Podcast. Today we are talking taxes. Now, 2 weeks ago we looked at how investing principles can guide us in times of fear, in times of irrational exuberance, and I left you with the thought that in our next pod, this one, we may actually revisit for the fourth time this year the 2024 presidential election. But really since then, and as of the writing of this podcast, there really hasn't been much news on the presidential election. Last night was the VP debate. I have my thoughts on that, but I actually think, both the candidates kind of did okay. Now, current Vice President Harris really hasn't been making much news at all. She hasn't really done an official, news conference or anything. So it's kind of hard for us to look through policy and deal with it in terms of the market. So the polls are still pretty tight right now. Again, as of recording this podcast, most would show a slim kind of leaning towards an electoral victory for former President Trump. But to be frank, at this point, I'd rather just focus on something else until we know a little bit more about the direction we're headed. Now, also in the news, obviously, is the Iranian missile attack on Israel. And so that's fresh news, and obviously the hurricane. So there's a lot going on in the country right now. I want that to kind of flesh its way out before we really start talking about the effect of, for instance, war or natural disaster on the market. So we'll get to that, but today's not that day. Today, we're going to talk about, everyone's favorite topic, which is taxes. And as we enter the fourth quarter of the year, I'd like to really turn some attention to taxation because my family recently finalized our 2023 taxes. And so it's been on my mind. And in context of a presidential election year, I'm looking towards 2025 for my family and my clients and really thinking through things we can do from a tax standpoint in the future, especially in light of the fact that we've got the last tax cut is sunsetting in 25. So in 26, we'll be dealing with different brackets, et cetera. So I'm going to just throw this out there. This is a huge disclaimer. I am not a CPA. I do not prepare my own tax returns, nor do I ever want to. And I do not prepare my clients' tax returns, nor do I ever want to. But I do help design tax strategy for myself, my family, and my clients. And really in terms of like where we should place money so as to help mitigate taxes in the future when we begin to take income from our assets. The whole point really of accumulation planning is to take cash flow, current income, that cash flow generate assets. And then ultimately we want those assets to then provide income to us. We just reverse the process. We retire, we go into distribution, we take those assets, we use income. But really net income is the game. Gross income doesn't matter. It's net income that's the game. And that's what I'm always really looking at for myself, my family, and for my clients. So I'm going to say this. Every one of you who are listening, who are within, 5 to 7 years or so of retirement, should absolutely be thinking in terms of an income policy statement. And we did a podcast on this about a month ago. You might want to go back and review that. We talked about simulating cash flow in retirement, talking about an income policy statement. Well, an investment policy statement states how we will build a portfolio and how we will maintain that portfolio. An income policy statement is a plan that states where we will pull income, in what order we will do that, and when we will do that. In order to optimize investing or income distribution, we have to be observant of not only where taxes are today, but where they may be headed. So, big hockey fan, and Wayne Gretzky famously was quoted as saying, he doesn't skate to where the puck is, but to where the puck will be. So to plan 10 plus years down the road, only using current tax code, it just doesn't make a lot of sense to me. So let's look at a situation where taxes may go up. Now, to be sure, I'm not predicting taxes will go up. I can see the national debt rising like you can, and I can, like everyone else, I don't really know how the federal government is going to deal with this. I don't think they know how they're going to deal with this. I would assume that it's possible they could increase taxes on folks in order to raise revenue. And if they do that, I can safely assume it would be politically expedient of them to raise those rates on higher income taxpayers. Why? Well, there's less of them, so they're going to lose less votes on the higher income taxpayers than on the lower income taxpayers. So I might be right. I might be wrong. The idea is to build your balance sheet in a way that it works well no matter what happens with taxes. But look, if we only build your future on the current tax code and then the taxes go up, well, I think that's just a huge opportunity missed. So if we build your future to work, even in the face of rising taxes, and they go down, there's no harm done there. Your plan's still going to work. So what can a future tax increase look like? Well, I guess that answer really just lies in the dreams of our politicians. But, there's a saying out there, and it goes something like, history doesn't repeat itself, but it rhymes. So we can look at the past to see what politicians have done before in terms of taxation. So we're going to take a time machine right now back to 1950. In 1950, there were 22 brackets for married and filing jointly clients. Okay, 22. Today there are 7. So things have changed greatly. In 1950, the top tax bracket was, you ready for this? 91%. In 1950, the top tax bracket was a 91% doozy of a bracket. And there's a chart that will show this, kind of like a bar chart, if you can think through it. And I've shown this several times over the last decades. And normally I don't do this with clients because I don't want to freak them out. I do it when I speak to financial advisors. I'll be in a room of 600 advisors and I'll talk about this. And somebody will say something either at the microphone or at a breakout. They'll say, hey, look, Joe, it's true what you're saying, but hardly anybody paid that 91% bracket. And that overall, the effective brackets from back then are about the same as they are now. Well, is that true? No, that's not true. I actually read an article about this the other day that said exactly what I just mentioned. I hear, and it's just not accurate. So here's where they're coming from. So in 1950, in order to be in the 91% bracket, you had to make over $400,000 of income. Okay, that was in 1950. So if we adjust that for inflation, just using the consumer price index, $400,000 in 1950 means you have to make about $5 million today in 2024. And that's where they're like, aha, see, I told you, no one I know makes that. Okay, fine. Let's use numbers that I see more commonly in my business. And I'm just going to kind of, go on averages here. So let's say hypothetically, I have a non-retired W-2 client. So if you're listening to me, this is, you're an executive, or maybe you're even in a, well, maybe not C-suite, but you're an executive at a Fortune 500 company. And you make roughly $400,000 a year today in 2024 dollars. And let's say hypothetically, I have business owner clients who report on average $800,000 in adjusted income. Now, if my W-2 clients who are making $400,000 today, if they were alive in 1950 and we reverse engineer that inflation adjusted income, then basically they're making about $31,000 in 1950 dough. Okay. So what does that mean? It means that their effective tax would be about 32%. Now, interestingly, their marginal bracket, remember we mentioned those 22 brackets. So as you march up the progressive tax bracket, their high marginal bracket, they'd be in 47%. And so why that's important is that if you've got investments with me in non-qualified investments and they earn income or short-term capital gains, that money is taxed at the marginal, not the effective. So in 1950, if you were making today $400,000, yeah, you're paying 32% average, but all of your interest income is being taxed at 47%. Almost half of your earnings is going away to taxes if the brackets were like they were in 1950. Now, my business owner clients, or maybe if you are a C-suite executive and you're earning quite a bit more, and this is low, really, frankly, but let's just say it's $800,000 that you're earning in 2024 dollars. That $800,000 reverse engineering the inflation in 1950 means you earned about $62,000, which means if you were alive in 1950, your average bracket was 45%. Your marginal bracket was 65%. Now, let me put this in context, okay? If you were that W-2 client that we talked about a minute ago, and we said that your effective bracket was 32%, in 2024, your effective rate's only 21%. The business owner or C-suite executive clients who we said were paying 45% effective back in the day in 1950, today your effective number is only 27%. Almost half. I mean, it's significantly lower. today. So what? Right? That's what you might be asking. Like, where's he going with this? Man, those taxes seem high. Well, here's what occurred. As the years went on, we had a few administrations. We had leaders like JFK and Ronald Reagan greatly reduce the federal income tax brackets. Not only reduce them, but also consolidate them, right? Obviously, we went from 22 back down to like 7 where we're at right now. But in order to do so, both those leaders I just mentioned, JFK and Ronald Reagan, they gave up a lot of the deductions that taxpayers enjoyed in the past. So it was JFK's policy. Now, he had been deceased, and so it was Lyndon Johnson who was in office, and Reagan. They both did the same thing with Congress. They said, look, we want to lower income tax brackets, and Congress, what we're going to do is we're going to give up some of these deductions. And so it's kind of horse trading. So what was the result? Well, the result was a lower effective tax bracket today, but also less deductions. So what might this mean in the future? Well, I don't know. The answer is I really don't know. But with current national debt reported, I'm getting the source from the U.S. Treasury, as of October 1st, 2024, our debt stands at $35 trillion and rising rapidly. Now, according to the Congressional Budget Office, that in the next 4 years is projected to increase by $12 trillion. So 35 to 47 trillion in just the next 4 years, assuming no new spending. So it would stand to reason Congress may look to increase taxes. Like, they got to raise revenue somewhere. They can also cut spending, but I think, I don't know if either side is willing to really do that. So if we assume that's possible, then we should plan on them increasing the taxes. And also, do you think they're going to increase our tax deductions? Are they going to give those back to us? Well, no. What would that help, right? They're not going to increase taxes and then let us deduct everything. So this happens a lot. Even President Trump, when he reduced taxes back in 2016, 17, whenever that was, we gave up some deductions. We gave up some mortgage interest deduction. We gave up the ability to write off state taxes, et cetera. When they go back and they increase the taxes, they're not likely to give us those deductions back. Therefore, we may be in a lower tax environment now versus what we could see in a decade plus. So how do we plan for that? Well, a few things come to mind, and these are in no particular order. Okay, so it's not like one is better than number 4. I'll just throw this out. Number 1, we got to be very efficient in our investment portfolios. Long-term capital gains rates are usually much lower than short-term gains rates or income tax rates. So when we build our investment portfolios, we have to keep an eye on that. We don't want to just have a lot of turnover in these portfolios for the sake of looking good. We have to be very, very efficient to keep those ordinary income tax rates mitigated. Number 2, take advantage of Roth 401k elections where we pay our taxes today and then enjoy later tax-free withdrawals. Why am I not saying Roth IRA? Most clients are making too much money to do a Roth IRA. Your incomes is just exceeded, and so you'd have to do backdoor Roths, which is fine. But I prefer what a lot of your employers now offer, these Roth 401k elections where all of your income that you're putting into the 401k will be taxed today and then put into a Roth. And then when it comes out later, we don't have to worry about federal taxes. Number 3, this is kind of a small one, but I like it. Utilize health savings accounts where you get deductions today. You also get tax-free withdrawals in the future for qualified medical expenses. Now, to my knowledge, it's the only really triple tax benefit we have in America where you get a deduction today, you get tax-deferred growth, and as long as you take it out for qualified expenses, then it comes out tax-free. That's a wonderful area. Now, it's a relatively small one. You can put, I think next year a family can put roughly $8,000 into there, but something is better than nothing. Number 4, you need to look at whole life insurance and incorporate that maybe into a wealth building strategy where, again, we pay taxes today, but we can help mitigate taxes in the future on withdrawals. Not only that, but the death benefit of life insurance is tax-free, income tax-free, not estate tax-free. So you can utilize this in a really well-designed income strategy where you can effectively spend other assets and help mitigate taxes because maybe you're using capital gains rates, et cetera. So where are taxes headed? I have no idea. I can't predict the future. But I want your income policy in retirement to work no matter if taxes are higher or lower. And to do that, we can't simply just hope for the best and do what everyone's been doing for so long and for decades. We need to be very proactive versus very reactive. Everything should be on the table for us to look at. And so those are just 4 areas that we might look at. And the reasons why we might look at that is, again, in this political environment where really nobody's talking about cutting spending. In fact, they're talking about spending more. We have to be aware that taxes could go up. We have to plan for that for you now, not 5, 10, 15 years in the future. And that is it for today's podcast. Now for the juicy compliance part. Registered Representative and Financial Advisor, Park Avenue Securities, LLC, Pass, OSJ 5280, Carroll Canyon Road, Suite 300, San Diego, California, 92121, 619-684, 6400. Securities products and advisory services offered through Pass, member FINRA, SIPC. Financial Representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. Pass is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of Pass or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC, California Insurance License Number 0D34103. This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Past, Guardian, or Westpac Wealth, and opinions stated are their own. Guardian and subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value due to both to real and perceived general market, economic, and industry conditions. This material is intended for general use. By providing the content, Park Avenue Securities LLC and your financial representative are not undertaking to provide investment advice or to make recommendations for a specific individual or situation, or to otherwise act in a fiduciary capacity. Past performance is not a guarantee of future results. Indices are unmanaged, and one cannot invest directly in an index. 706-9617 expires 10-2026.